Okay, so thank you very much for joining in. I thought we could quickly get into another topic, which we are referring to as foreign exchange risk management, right? I think last time we tried to look at interest rate risk, but now I think it is time that we looked at the issue of foreign exchange risk as well. Okay, which is also quite significant. Okay, yeah, all right. Okay, fine. So, again, remember that when you're looking at foreign exchange risk, really, as we have rightly outlined here, this is the exposure to financial loss, which is resulting from fluctuations in exchange rates, right? So, because of the fluctuations in exchange rate, we are at risk of losing, financially. Okay, I think it is very important from the onset that we look at some of these, the major types of foreign exchange risk, right? So remember that we have what we call transactional, right? Okay, transactional. Let me just get rid of this. Okay. Okay, so there's what we call transactional risk. Now, with transactional foreign exchange risk, basically what we are saying is that what is at stake here, okay, is an actual amount. Okay, what is at stake is an actual amount or an actual cash flow. Okay, an actual amount or an actual cash flow, which is either an inflow, okay, or outflow. Okay, and remember this is either, also maybe we are saying either a receipt, okay, or a payment. Okay, um is at risk. Okay, is at risk, is at risk. Okay, is at risk. Now the question is, how do we explain this risk? You see, the risk is explained by a gap. Okay, and this gap is the gap between, okay, is the gap between um you know um it's the gap between the contract date, okay, contract date, okay, or you can say maybe the time that you are given the invoice. Okay, so the time between the contract date, okay, and the settlement, okay, or payment date, right? Or payment date. So basically, this is what is happening. So we have a situation where you have been given an invoice of, 100,000, right, US dollars, and we are saying you need to pay this in the next 3 months. Now, what we are saying is that this gap here, anything can happen to the exchange rate. Okay, and the exchange rate can vary. Okay, and once it varies, you find that in kwacha terms you'll be paying more than you are supposed to. So for example, if at the moment the kwacha was at 10, then it means that in kwacha terms you would be paying 1 million, right? 1 million. Now, if the kwacha, depreciated, okay, to here to 12, then it simply means that you'll be paying 1,200. So you have made a loss, okay? So because of this gap, okay, between the time that you are given, you get into this contract or you're given this invoice, okay, until the time that you actually make a payment. Now, this can either be a payment or it can be a receipt, but it is possible that you might make a financial loss. Okay, it is very important to understand transactional risk, as it concerns foreign exchange risk. Okay, the other one, okay. So anyway, so definitely this case you're saying that it is definitely affecting profit, okay, or profitability, and it is definitely also affecting your cash flows. Okay, so here there is a direct link. I think that is the reason why, if you notice, um, the banks are quite clever here, because they always put a caveat. Okay, so whenever they are giving, whenever they are quoting, exchange rates, there is usually a caveat at the very bottom, which will talk about how these rates are indicative, right? So, in other words, they fluctuate according to the market, and if the market fluctuates, the bank has got no commitment to honoring what you saw, okay, because it might mean that the markets have moved. Okay, so basically that is that. So banks also appreciate the issue of foreign exchange risk, and they put that caveat. Okay, yeah. So anyway, uh, the other one that we can talk about really quickly is the what's this? The translation risk, right? So translation risk. Now, usually, they actually call this the balance sheet risk. Okay, balance sheet. Okay, risk. But basically, what we are talking about is what we call the translation. Okay, risk. Okay, so for the translational risk, basically how it is coming in is that, you see, it is mostly affecting, mostly multinationals. Okay, multinationals. Okay, who have different subsidiaries in different countries. Okay, okay. So they have different subsidiaries in different countries. For example, Zambia, South Africa, and so on. Okay, and then maybe this company is based in the US. Okay, so, and anyway, that is typically how it is. For most of these banks, you find that they are based, they are headquartered in the UK or in the USA. Okay, and then they have subsidiaries in Africa and so on. Okay, but basically, what we're just trying to say here is that I know we have done financial reporting. So you find that at some point, okay, due to regulations in their home country, right? So in the regulation, for example, in the USA, due to regulation in the USA, they want this conglomerate or this multinational to do what we call a consolidated, okay, financial report. Okay, they want them to do a consolidated financial report, meaning that we have to translate everything from our subsidiaries into the reporting currency. Okay, into the reporting currency. Okay, so you find that at translation, assets, okay, and liabilities, okay, denominated in different currencies, okay, when translated back, okay, might actually be lower or undervalue, right? Okay, so these assets, when you're translating, you might find that because of how the exchange rate is at that particular time, then it might be that they are over or undervalued. Okay, and think that is a no-brainer. So basically, the catch is that it is happening at translation, it is happening at your financial reporting stage, where you're supposed to do your consolidated, accounts. And, this can be quarterly, this can be yearly, and so on and so forth. So at that particular time, that is when you are affected by the exchange rate changes. Okay, and it might actually affect your profits or even your losses, your reported profit or your reported losses. So that's basically that. I thought we could have that understanding before we get into the hedging products. Okay. So having understood foreign exchange risk, okay, let us look at some hedging methods, and I think today we'll just concentrate on the financial hedging methods, the internal hedging methods, or sometimes we call them the organic methods, right? Organic methods. Okay, so these are seen to be cost effective, obviously, okay, and somewhat long term in terms of like strategic planning. Okay, so that's basically what is happening. So the first one that is being highlighted in these notes, okay, is exposure netting and matching. Okay, exposure netting and matching. So we'll start with the issue of matching. Okay, we'll start with the issue of matching. So when it comes to matching, all we are saying here is that you are trying to match. So what are you matching here? You are matching the timing. Okay, you are matching the timing, okay, and offsetting exposures, and offsetting, exposures, okay, exposure, okay, to one currency, okay, to one currency, okay, to one currency. So basically this is that. So an example here that we are being given is that if we are looking at a US firm, right, which has a large euro receivable in 90 days, okay, and then it has got a payable in 60 days, then the best would be to actually delay your payable, okay, by 30 days, meaning lagging, okay, a method called lagging. So you want to lag it so that you match the time that you're getting your receivable. Okay, so this definitely will reduce your exposure to that exchange rate. I think this is very profound. Okay, this is very, very, very profound. Okay, because imagine a situation where, okay, you maybe your receivable is euros. Okay, your receivable is maybe 10,000, okay, euros, okay, as in your receivable, okay, and then maybe your payable is 16,000, okay, 16,000, okay, okay, 16,000. So what is going to happen here is this. When you delay, okay, so this is how much you're supposed to pay, this is how much you receive. So when you delay, it simply means that that 10,000 that you receive will go straight to offsetting part of the 16,000, meaning that the only amount you would have to buy on the market would be, your 6,000 euros. Okay, your 6,000 euros. Okay, unlike you buying the entire 16,000 euros, you would be exposing yourself. Okay, you would be exposing yourself, because again, the issue of buying, and then when you receive your amount again, you convert it back to the currency where the dollar, then that becomes too much of a challenge. So in fact, Imagine if this was a perfect situation where you are receiving 10,000, okay, euros, and then you also have to make a payment of 10,000 euros. It simply means that without even touching this money, you just make sure that this money goes straight to offsetting this, and you would have not there would be actually zero exposure in that situation. Okay, so I think it is important, okay, that we look at that, okay, because it is really, protecting us. It's one of the ways that we can do it. So yeah, matching the timing so that you at least try to, do some kind of like offsetting of the exposure. Okay, some kind of offsetting of the exposure. So lagging, but sometimes you can actually use what we call leading. Okay, you can also do what we call leading. Okay, leading. Okay, and leading is just the opposite of lagging, meaning that if, for example, you are receiving this receivable in 30 days, and then you are making this payable in 60 days, why don't you lead? That is, why don't you pay 30 days before? Okay, 30 days before. Okay, so basically that is that. It's the same thing. Okay, so the other one is netting. Okay, the other one is netting. Okay, so what does this mean? So for netting, we are saying it involves consolidating all intercompany payables and receivables in a single currency through a centralized netting center. So again, this is mostly common for multinationals. Okay, so what we are saying is that it significantly reduces the volume of external transactions requiring hedging, lowering the cost and the need for funding. Definitely helps with the issue of the translational risk that we talked about, okay, which is the balance sheet risk. Okay, let me see if we can look at a quick example. Okay, so imagine a situation where we have got 3 subsidiaries. Okay, imagine we have subsidiary A, okay, who owes B, let's say it owes B how much? Okay, let's say it owes B it owes B 10 million. Okay, let's say it owes B 10 million. Okay, and then B owes C, the subsidiary C, for example, let's say 5 million. Okay, and then we have got C owes B, maybe C owes A. Okay, how much? Let's say maybe 2 million. Okay, so now if we do not do any kind of netting, then it means that C would have to send 2 million to its subsidiary counterpart A, 2 million, okay, and then A should send to B, and then B should send to C. All these transaction costs, okay, transaction costs at the bank and so on, and just your exposure to foreign exchange risk. So to avoid this, what you want to do is you can actually net this out, okay, whereby you know that this central centralized netting center, what it will do is that it obviously it notices here that A owes, C owes A 2 million. So meaning that in terms of effectively how much A will release is 8 million, right? It will release 8 million, okay? A will release 8 million, okay? And it's the only firm that would have to release 8 million. Why? Okay, is because of course it owes 5 million to, I mean, sorry, yeah, so it will only release 8 million, okay, and then notice that only 5 million will go to B, okay, so B gets 5 million, okay, B will get 5 million. This is like net of what it owes, right? So B will get its 5 million, and then C will get its 3 million, okay, which is net of the 2 million that it has given out. So effectively, that's what we are saying. We are saying that instead of 10, it's 5 million that this one will get because of how much he owes C. And then C will only get 3 million out of that 5 million, okay, because the 2 million has gone to A. I hope it is not complicated, but at the end of the day, only this amount will be used. Okay, anyway, so basically that is that. So other methods which are organic would include the issue of currency invoicing and pricing. Okay, so again, this one is like a simplest method that you could use. Basically what it simply means is that if you are a US exporter or if you are a Zambian exporter, okay, so the Zambian exporter demands payment in the Zambian what? In the Zambian kwacha. So if you can demand, as a Zambian exporter, you demand your payments in the Zambian kwacha, then effectively it means that you have transferred the risk to the buyer. Okay, you have transferred the risk to the importer, because whatever happens for you, if you have priced your goods at say 1,000 kwacha, then that's what you're expecting. You're expecting 1,000 kwacha. Okay, whether there is any fluctuation, you are getting 1,000 kwacha. Okay, you're getting 1,000 kwacha. Okay, so maybe let me just try and flip this. Let me try and flip this example where we say that the exporter is a US, okay, USA, and wants to get his 1,000 US dollars, okay, and then the importer is Zambian, right? Zambian. Now, the exporter is demanding that you pay me in dollars. So meaning that the exporter wants to basically reduce its or eliminate its exposure. Okay. So basically what it means is if the exchange rate is 20 kwacha to a US dollar, then even if, so meaning that if it is 20 kwacha to a US dollar, then me as someone who is in Zambia, who is an importer, then I have to make a 20,000 kwacha what? 20,000 kwacha payment. But if the currency, the Zambian currency depreciated to 22, okay, then it means now that I have to pay 22,000 kwacha. Okay, 1,000 kwacha. But effectively what I'm paying is $1,000. Only that for me, I am now having to spend more kwacha to buy those dollars that is needed. So the risk has come to me, but not to the exporter. So what we are saying is that, yeah, this would definitely eliminate your transaction risk, But then the challenge is that it might negatively impact sales volume if foreign buyers resist. So basically that is that. So for me, like, why would I want to pay all this amount? So I might resist, right? Depending. Okay, maybe I think about other sources, okay, where I don't have to spend too much. Okay, so because of that, we are saying, okay, if you are smart, maybe you can go for some clauses which we call the risk sharing clause. So in this one, what you are saying is that you can do a bit of sharing, especially if the spot rate, falls outside the band. So what we mean is, you might have this band where you say plus or minus 2 kwacha. Okay, so you're saying you are willing, okay, to pay anything in this exchange rate, whether maybe $1 to 21, 22. Once it goes to maybe, for example, 23, then you are not really willing to do that. Then the issue of sharing comes in, meaning you share the loss in this case. So if I am the importer, instead of me paying 20,000 kwacha, I'm paying 23 kwacha. Okay, remember that my loss is 3,000, so you find that we may need to share this 3,000. Okay, okay, so that's basically what we mean, because it has gone out of this the limit that we have defined for ourselves. Okay. Okay, and then finally for today, the other one is, what we call current asset liability management, CALM, okay, or CALM, okay, current asset liability management. Now, this one is also quite profound, because what it means is that your long-term assets and liabilities are being structured, okay, to create an internal balance sheet, hedge. Okay, a good example, very clear here, is, imagine you are a firm who is trying to buy maybe a factory in Japan, and you know that if you're going to buy a factory in Japan, it will be dominated in the yen, right, the Japanese yen. Okay, so because of this, you decide that, what, for me to buy this, I am going to issue a yen denominated what, debt or liability, or even a bond, okay, so that you fund this. Okay, so this means that if the yen appreciate, then it will translate into the value of the asset appreciating, but also the value of your liability increasing at the same time. So in other words, what we are saying is that the cost maybe of this factory is 10 million, okay, 10 million Japanese yen, right? Okay, so what you do is you go to a Japanese bank and borrow this same 10,000 yen. Okay, then what it means is, if the yen fluctuates or whatever happens, then it means that this asset that you have in the yen increases, but also this liability that you have incurred also increases by the same proportional margin. So as a result, you find that you have a way of at least minimizing this translation risk, especially at consolidation, because your liability coming from a certain subsidiary is corresponding with the asset. So you find that here you may not have evidence of a big loss or something of that nature. So that's what is happening. I think we'll end it here for now, so that I allow you to assimilate the information, and then tomorrow I will be sharing another part where we look at now the derivatives, okay, the forward transactions, the futures and swaps, and then the currency swaps, of course, and then yeah, we do again more options, okay, and so on and so forth. So basically this is what we are going to do tomorrow. For now, please study this material, and then we'll meet again tomorrow. Thank you very much.